Welcome. So if the Fed's going to 6%, do you still see more pain for the equity markets, which is not quite priced for that?
Yeah, absolutely. And I think the reason we see it going to 6% is, don't forget, the biggest consumer commodities on the planet has been shut down for 3 years. And China has exited zero COVID in December. And so from our perspective, you look at inflation and what it's done, it's come down a lot driven by commodity prices during this period of time. With China opening up, we actually have our portfolio in a lot of commodity-driven names in copper, aluminum, oil, et cetera. And I think what you're going to see is by mid-year, commodity prices starting to really pick up as China starts to consume again. And then don't forget, their consumers are also sitting on about $1.2 trillion in excess savings that they're going to start to spend now that they've been unlocked. So that's why we see inflation kind of staying strong. And then obviously you've got twice as many job openings as people unemployed. That's going to keep wages strong, and that's 55% of PCE. That drives the Fed to 6% versus expectations of some rate cut that people had been thinking up until now.
So let's talk about how you're positioning for that setup. Dan, I looked to you and was wondering if you were in sexy tech stocks, some name we haven't heard of or that's been hammered. And I see the first one on your list is a 3-month T-bill. Why?
Well, as you opened up with, right, our portfolio is a mixture of offense and defense, because our belief is that as you get into the back half of the year, the positives of you've got $1.5 trillion in U.S. consumer excess savings, that's going to be depleted by the back half. You're going to have inflation pick up. I think you're going to see new lows for the S&P 500 as you get into the back half of the year. So in that scenario, you want to have a combination of offense and defense. Remember, when we started last year, a 3-month T-bill, I think, yielded about 3 basis points. Now you can get about 4.8% on that. And so you want to have some cash on hand, especially if you think the S&P has a good shot of getting to 3,000, which is kind of where we think it'll end up ultimately. And we have, healthcare in there as well, the XLV, for the same reason, to give you some defense. But we also have some offense in there. Meta, obviously, that's done pretty well this year. We think it's going to keep getting better based on some of the Advantage Plus tools that they have coming, which is AI-powered advertising. I think that's going to do pretty well. And then we own a Japanese bank, MUFG. We think that's going to do really well as Japan gets away from yield control. So we've got this mixture of offense and defense sitting in the portfolio. And as I said earlier, we have commodity stocks that'll do well with the China reopening.
Yeah, your Meta pick is interesting, Dan, because you're basically saying it's too cheap at 16 times. They've already taken their medicine, expenses getting under control, traction on reels. But aren't there other companies, maybe not at that size, which have gotten cheap and which have at least taken the bull by the horns on expense control and even CapEx control?
Well, remember, the last piece is valuation. So you've got Meta trading at about 15 times. The S&P is trading at 18 times. And don't forget, they lost about $10 billion of revenues when Apple put in their privacy changes. So that's, they're lapping that, and their new tools are really helping them with efficiency for advertising. So you put that together, and you have to consider the valuation piece of this, because just because something's down 90% doesn't mean it's cheap. It just means it's down 90%. And if it's unprofitable, you've got a bigger problem in there, in that if the market gets worse because the Fed has to keep raising rates, those companies are going to run out of money. So down 90% doesn't mean it can't go down another 100%. So I think that's the last piece that people have sort of ignored, because for the last 13 years, every time the market looked like it was going to stall out, the Fed was able to stimulate the market, cut rates further, and so that kept the party alive. Well, that's because you didn't have any inflation. You've got high inflation right now, so the Fed's got a completely different playbook, and people are still going back to the playbook of the last 13 years.
No, it's a great point, and that lost Fed put is so interesting. But I gotta wonder, if in fact you're right about S&P getting to 3K, how does the Fed commentary sound at that moment?
Well, here's the thing, right? They've been very clear about this. They need to get inflation under control for the long term. And if you go back to the 1970s, we have this playbook. And the Feds looked at that and said, The Fed prematurely cut 3 separate times, including Volcker, which people forget about. And then inflation took off again. And then the Fed had to raise rates even higher. And that was really painful and punishing. And so this Fed does not want to make the same mistake. And so we've got some charts on danniles.com that show, how many more jobs there are relative to people. And if you just big picture think about what happened to the U.S. economy when we got unlocked, right? Inflation really took off. So imagine what happens when the biggest consumer of lots of different commodities in the world, China, they've been locked up for 3 years. They're getting unlocked, and they're stimulating their economy because they don't want social unrest, which we saw in December. So that's the piece you got to remember as we get further into this year. That's going to put a lot of pressure on the Fed to keep hiking. That's why we think 6% is where you get to, and you get no rate hikes rate cuts this year because of that.